Hey everyone, thank you so much for joining us here for another, what I hope will be an exciting and educational, interesting version of Market Takes. I am your host, reporter Dion Rabouin with the Wall Street Journal. As you see right there, we're going high tech, baby, here in 2022. But thank you so much for being with us here on Market Takes. Look, we are breaking down, diving in, opening up, doing all things to get into this FOMC meeting that we just had for November. Fed Chair Jerome Powell, we're going to talk about what he said at the press conference. We're going to talk about what the FOMC said in their statement. We're going to talk about how the markets reacted to all that. We are going to get into everything and anything that there is to say about this big Fed meeting. Look, first of all, the first thing I want to talk about is the rate decision and the statement. The statement came out, the markets really liked it, and then things got a little different. Things changed a little bit. So we're going to talk about the outlook for December's FOMC meeting as well as 2023, because I think Fed Chair Jerome Powell really set that up with his remarks at this meeting in terms of what we can expect for the future. At least the market seemed to definitely take it that way. Obviously, we're going to talk about the market reaction, stocks, bonds, crypto, commodities, FX, the dollar. There were some big moves in currencies that we're going to talk about. And of course, we're going to talk about what comes next. So thank you so much for being with us here on Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. So look, let's get into it right now. The Fed raised rates by 75 basis points. That's 3 times the normal average. It's starting to become a bit cliche or, not even necessarily correct, because they've been raising now. This is the fourth 75 basis point hike in a row. This is incredibly abnormal and unusual policy. And I want to throw a chart up here on the screen just to illustrate how unusual this is. Now, this chart goes all the way back to 2009. You can see their rates were really low, right around zero for years, almost a decade. And then in 2016, you get that first rate hike, and you see how rates gradually went up there on your screen. Now you look at 2022, and you got just like a hockey stick. That's what 75 basis points over and over and over, 4 times in a row. After hiking 50 basis points in May, after hiking 25 basis points in March, that's what this looks like. So when you're talking about the unusually fast rate of rate hikes that we've seen this year, that's what it looks like compared to a much more normal rate hiking cycle that we saw from 2016 to 2019. And then if you remember, the Fed famously reversed course. That was that Powell pivot 1.0 in 2019. And then in 2020, you saw that move right to zero as the coronavirus pandemic struck the US. So just wanted to throw that up there to illustrate just how unusual this rate hiking cycle has been so far in 2022, and why some folks are getting a little bit worried that maybe the Fed's doing too much, maybe they're moving too fast, and why Fed Chair Jerome Powell really responded to a lot of that in his press conference today. Now, the first thing I want to do is, like I said, I want to talk about that statement, because the 75 basis points was as expected. The market wouldn't have reacted too much, but if you were watching the stock market today, stocks were kind of down early on, folks were selling a little bit, and then you saw this statement come out and the market shot up. You saw stocks across the board, the Dow, the S&P, the NASDAQ, the Russell, all kind of jumping up, and that was in response to the statement. I want to read the big change in the statement. Now, there's a little bit of Fed speak. It's, some words that normal people don't use in normal conversation, but I want to read it to you, and I'm going to break down what it means. The statement said, this was an addition. This wasn't in the previous month's in September statement. This was added, quote, in determining the pace of future increases in the target rate, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Blah, 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 Fed speak. What that means, though, is that the Fed understands that they've moved very fast. You saw that chart that was up on our screen, just that big hockey stick up in terms of rates spiking up higher. They're saying, hey, we understand that we've moved very quickly. This is unusual, and that monetary policy works to lag. So what we do in June might not really affect the economy until December or until next June. We understand that. And really what the market was expecting that to mean was, okay, we're going to slow down and kind of start to set the stage for that Powell pivot 2.0. That Powell saying, if you look back at that hiking cycle from 2016, you go up, 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 and then you kind of hold and then down. And that's what folks were expecting to see really quickly happen. And Fed Chair Jerome Powell really kind of threw some cold water on those expectations at his meeting. The slowdown is the first step towards the stop, And then the next step is that reversal where we get rates back down from this level where they're at now, about 4%, 3.75 to 4%. That is very high relative to where we've been over the past 12, 13, 14 years, if you saw that chart going back to 2009. But big picture, when you go all the way back to the 1980s, 1970s, 1950s, and beyond, this is still low rates. So a lot of folks were expecting to see that Powell start to set the stage for the slowdown, which sets the stage for the stop in rate hikes, which sets the stage for the reversal. We did not get that. Now, I want to take a step back and talk about the outlook for December. And that really is, what set the stage for this meeting as we were coming in, right? So we had that high September CPI report. CPI year over year was 8.2%. And the core was up 6.6%. Now, that core reading, which strips out food and energy prices, which are very volatile, which have been spiking higher most of this year and actually had kind of started to come down the last few months, stripping that out, core prices were rising at a faster pace than expected and the fastest pace since 1982. So you had that core inflation, which is what the Fed really has more control over, rising at the highest pace or the fastest pace since 1982. You also had Eurozone inflation accelerating to 10.7%. That's the record high. So remember, central banks think globally, they act locally. So what's going on with the ECB, what's going on with the Bank of Japan, what's going on with the People's Bank of China, all that factors into the Fed's decision making. We also had a strong third quarter GDP report, 2.6% above expectations, but we saw the PCE, that's the Fed's favored gauge for inflation, slow to 4.5% overall, and we also saw the GDP deflator at 4.1% versus 9.2% or 9%, excuse me, hit in the second quarter. Go back and watch my live stream on GDP that we did last week. Check that out. I explained why that GDP report and why that PCE number were so important. Basically, it suggested that inflation was slowing down and that we were starting to see some of the things that the Fed wanted to see. I talk all about that in that video, my last live stream on Q3 GDP. The big thing that folks are starting to worry about is that the Fed could over-tighten. And Fed Chair Jerome Powell made a point to mention the strong jobs reports that we've seen, as well as the number of labor openings that we're still seeing. The JOLTS report, Job Openings and Labor Turnover Survey, which came out just last week, that showed there were still 10.7 million job openings in the US. The Fed wants to see that come down so that there's not more job openings or not 2 times as many job openings as there are for every unemployed person. And you start to see the labor market balance out. They've made a big deal of that. We have also seen a slowing of the jobs reports coming in. So in July, 528,000 jobs added. In September, 263,000 jobs added. In August, 315,000 jobs added. And then in September, 263,000. So 500,000, 300,000, 260,000. That's moving in the way the Fed wants to see things. But again, a lot of expectations for Fed Chair Jerome Powell to start the pivot. He did not. And we're starting to see more folks worried that the risk is that the Fed over-tightens, does too much, sends the economy and the country into a recession, and that hits a global recession. I want to read a quote here from Gene Boivin. He is the head of the BlackRock Investment Institute. He says, quote, "We see central banks on a path to over-tighten policy. We think the Fed, like other developed market central banks, will only stop when the severe damage from rate hikes is clearer. Rates have already hit levels that may trigger recessions in our view." That's the growing consensus from economists. A lot of folks think the Fed has already done too much, that rates are already too high, and that the economy isn't able to handle it. Not just rates in absentia, oh my God, rates are too high. No. Based on what is going on with the economy, with the relative strength or weakness of the economy, a lot of economists are saying rates are already too high. We've already hit these recessionary levels, and the likelihood of a recession is growing significantly in 2023. And that was the worry coming into this meeting. So that is how we sort of set up coming into the Powell press conference. And Fed Chair Jerome Powell, if you were looking for hawkish Powell, if you were looking for Powell to come out here and lower the hammer and say, we're still trying to rein inflation, well, you got what you wanted. I know a lot of folks who are in the stock market were not looking for that, but that's what they got. Powell really came in here and said a lot of things that I think a lot of folks in the markets weren't really expecting to hear. He really talked about, the expectation for a slowdown in rate hikes going forward. And he said, quote, "We still think there's a need for ongoing rate increases, but we still have some ground to cover, and cover it we will." Again, the Fed Chair Powell saying, yeah, the statement said, okay, we see that we might be doing a lot of damage to the economy. We're going to reassess. And then Powell comes out and says, but we still have some ground to cover, and cover it we will. Um, he also said, from a risk management standpoint, we want to make sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon. Seems like he still thinks the worry is not doing enough, rather than the worry being that they have already done too much and that they could be doing very serious damage to the economy. He also said the change, and when he's talking about the change, he talks about the change from this aggressive policy of rate hikes to changing to slowing down, to stopping, to reversing course. He says that change could come as soon as our next meeting or the meeting after that. That's important because markets had already lined up a smaller rate increase in December, and then the Fed slowing down and stopping further out. Well, he's saying it might come next meeting, it might come the meeting after that, which is in February, might come after that, which would be down into March of 2023. So it's really interesting that Fed Chair Jerome Powell kind of took where the statement was going, which was positive for stocks, positive for risk assets, and he really went the other way. And that's why we've seen the moves in markets that we have. And so I want to direct your attention here and just talk about what we saw in the markets today, because after that statement was released, you did see the stock market really pick up, jump higher. You saw treasury yields kind of come down. And then during the press conference that Fed Chair Powell put on, you saw just a complete reversal of that. Right now, as I look out at the stock markets, the NASDAQ is down about 1.8%, S&P 500 down 1.2%, the Dow is down 0.5%. And really, again, we were up positive after that statement was released, and markets just did a complete reversal of that. Now, the other interesting picture, as it always is, much more important to look out at the bond market. You saw yields coming down, as in folks buying bonds saying, okay, it's safe to get back into the bond markets. We have seen liquidity really dry up in the treasury market, which really means folks just aren't buying. Banks aren't getting in there and buying. Big investment asset managers aren't getting in there and buying. Folks are kind of staying clear of the treasury market, and we're seeing liquidity dry up. And so you kind of started to see when that statement came out, people saying, okay, Fed's going to cool it. They're going to chill out. We can kind of have some certainty in what we're doing. Let's buy some bonds. And then during this press conference, yields, especially on the long term, really picked back up, but across the curve. You saw the 10-year note, 7-year, 2-year, 5-year, 1-year, really across the curve, yields just picked and spiked back up. And that's also why you saw, when you look out at the currency market, the dollar rising significantly against all other major currencies. You saw the euro down, yen down, the pound down, Swiss franc, really across the board, all these currencies falling in value against the dollar. And of course, that hurt commodities as well. You're seeing crude oil still picking back up because there still seems to be a big pickup in crude. That's, another story for another day, but you're seeing lower numbers on gold, silver. You're seeing natural gas is up big, having a very big day today, but copper, corn, all these things kind of coming down as expectations for what's going to happen to the dollar. As the dollar strengthens, those things are measured in dollars, and their values is coming down as expectations for yields to go higher, as the expectation for the Fed to do more, to raise rates higher. Those are picking up, which makes yields go higher on bonds, which makes the dollar go higher, which brings currencies down, which brings other currencies down, which brings commodities down as well. Looking out at crypto, Bitcoin is still kind of hanging on to some of those gains from earlier in the day, but Ethereum is down big, almost 1%. Ripple is down about 1%. We are seeing a big downturn overall in crypto. Litecoin actually up about 10%, but again, on some of those individual factors for those coins. Look, big picture right now, the dollar is strengthening again. We are moving away from this bullish trend that we have seen over the last month. Remember, October was a huge month for the Dow, having its best month in years, or the best October in years, going up about 13%. Well, it looks like we could be reversing that, because that was largely based on expectations for the Fed to start this pivot process to move away from aggressive rate hikes and towards slowing down, then stopping, then reversing course and giving that Powell pivot, or giving that stock market put that we have known the Fed to do. It really seems like what we're seeing now is the Fed Fed Chair Powell really looking at investors saying, hey, you're moving too quick. We are trying to tighten financial conditions, make things more difficult, and really keep things tight so that the real economy kind of starts to slow down and those job increases start to slow down. One thing I thought was very interesting about the press conference from Fed Chair Powell is he talked a lot about individuals. He talked a lot about the jobs market. He talked a lot about what individuals have in their savings. Really didn't spend much time at all talking about corporations, about how corporations are flush with cash right now, so they can afford to have a couple not so great quarters and still keep prices high. He didn't talk about net profit margins for corporations, which are at record highs and are expected to move higher through this year. And those net profit margins mean how much corporations are making after they pay for higher prices. So even though the things they're buying are getting more expensive, they're raising their prices at an even faster pace. Didn't talk anything about that or the effect that these price raises are having. And as you know, I talked about this in a video that we did, I want to say it was back in June of this year, why corporations love inflation. Corporations love inflation because it gives them cover to raise prices, and they raise those prices by more than inflation, and that actually makes inflation keep going higher. Fed Chair Jerome Powell didn't talk about that at all. I think that's a very important thing that we have to keep our eye on. Last thing I want to mention before we get out of here, I know I'm running long, so I appreciate everyone that's stuck with me, that's still here with us on Market Takes. I want to talk about how Fed Chair Jerome Powell ended his press conference today. And it was interesting because he was asked a question about recession and about the odds for a soft landing. He said, quote, the inflation picture has become more and more challenging. Talk about how some of these supply chain issues have resolved, and you would have expected goods inflation to come down now, but that really hasn't. What he said was, with regard to the inflation picture becoming more and more challenging, that means we have to have policy become more restrictive, and that narrows the path for a soft landing. Powell really saying, you know what, we might have to have a recession. It might be bad. Folks might be suffering and hurting. We're okay with that because we've got to get recession in control. That looks like the big picture here, and that's probably why you're seeing a lot of the action that you are in markets. Look, I am Dion Rabouin, reporter for the Wall Street Journal. This has been Market Takes. Like I said, I know you could have been anywhere in the world, but you were here with me, and I appreciate that. Thank you. That's going to do it for us here on Market Takes. We will see you next time. Please come back and join us.